As the currency reset begins, get gold as it is where the whole world is heading. By Jim Rickards. This may be the most important commentary I've ever written. Here's why. For years, financial analysts have discussed what's called the Global Monetary Reset, or GMR. Expectations of a GMR stem from the fact that monetary policies around the world are unstable and unsustainable. Aftermath: 7 Secrets of Wealth Preservation in the Coming Chaos by James Rickards. There is no anchor to the system. There is no limit on money printing. There is no limit on debt creation. Such a system grows exponentially based on the false belief that governments can spend as much as they want and central banks will pick up the tab or bail out the system as needed. Politicians love the system because they can buy votes from their citizens. Central bankers love the system because of the power and prestige it brings them. Citizens love the system because they get handouts, bailouts, pumped up asset values and other goodies seemingly for free. What's not to like? The problem, of course, is that the system is unstable and unsustainable. It's a huge inverted pyramid of promises poised on a small sliver of real money called gold. It's bound to tip over and come crashing down as it has many times in the past, from the jubilees of ancient Israel to the global financial crisis of 2008. The 2008 panic would have closed banks and capital markets globally but for tens of trillions of dollars of central bank intervention. That bailout money printing has still not been mopped up. The 2008 bailout has sown the seeds of the next crisis. Viewing this broadly, an objective analyst can see that a new system based on some hybrid of dollars, gold, and the IMF's world money called special drawing rights, SDRs, is inevitable. This new system could even include an encrypted distributed ledger or blockchain, and might revert to fixed exchange rates instead of floating. The GMR would be a return to something like the old Bretton Woods system, 1944–1973, but with 21st century characteristics and technology. This is what is meant by the global monetary reset. That much is clear. The open issues for students of the GMR are when it happens and how. There are 2 answers to the how part. It can either happen in a proactive way by convening a new global monetary conference similar to Bretton Woods, 1944, the Plaza Accord, 1985, or the Louvre Accord, 1987. Or it can happen in a chaotic fashion in response to a new financial crisis, as occurred at the G20 Washington summit led by George Bush and Nicolas Sarkozy in November 2008. My estimate has always been that the GMR would be conducted in a panic due to the lack of leadership and foresight of the global monetary elites. The answer to the when part is necessarily uncertain, but given what we know about the dynamics of complex systems and the scaling metrics of the current international monetary regime, the best answer is probably soon. In a nutshell, a catastrophic collapse is coming, probably sooner than later, and the result will be an entirely new international monetary system in which the dollar is dethroned as the world's leading reserve currency and something new is put in its place. That's the GMR. What if I told you the GMR already happened and no one noticed? Here I have to acknowledge that some of the information that follows was provided to me by a source. The work of this source is tentative and requires more independent research. Yet it looks solid enough right now to share with readers. I'll be writing more about this revelation in my new book, Aftermath, coming October 30, 2018. You can pre-order a copy here. In Aftermath, I'll disclose more about the origin of this information. For now, I just want to be fair and acknowledge that it originated with an unsolicited research report sent to me from a correspondent named D.H. Bauer based in Switzerland. We'll call him DHB for now. Let's start with a simple analysis we've all done ourselves and expand that analysis with information from DHB. Then I'll provide some conclusions that stem from this presentation. We all follow the price of gold. We think of gold as about $1,320 per ounce. We say it is up or down by $10 per ounce and so on. When we do this, we are really quoting a cross rate between US dollars, USD, and 1 ounce of gold, gold. Let's call this cross rate USD/GLD. We also follow the cross rate between the US dollar and the Chinese yuan, CNY. That's the exchange rate between the currencies of the two largest economies in the world, which combine to produce almost 40% of global GDP. When China instituted a shock devaluation of their currency in August 2015, U.S. stock markets fell 11% in 3 weeks and it looked like there was no bottom. Then the Fed intervened with a delay of the liftoff in rate hikes from September-December 2015. China devalued again in December 2015, and U.S. stocks fell 11% again from January 1 to February 10, 2016. It took the G20 Shanghai Accord in late February 2016 to put an end to Chinese shock devaluations. This recent history reveals that the U.S. China cross rate is one of the most important metrics in world finance. Let's call this cross rate USD/CNY. Finally, if you're a geek like me, you take a look at the US dollar value of the SDR every day. It's not a secret. The IMF actually publishes that cross rate daily, found here. As of this writing, SDR1 equals 1.419 US dollars, but that rate changes daily like any floating exchange rate. Let's call this cross rate SDR/USD. Now, you all recall the transitive law from middle school math. In short form it says, if A equals B and B equals C, then A equals C. In other words, if you have two equalities, you can substitute a factor from one for a factor from another and still end up with an equality. Here's where DHB's insight comes in. He took the known quantities of USD/GLD and SDR/USD and applied the transitive law to calculate SDR/GLD. While I think about USD/GLD, USD/CNY and SDR/USD all the time, I have to admit I never thought much about SDR/GLD. Why would I? I don't own any SDRs and I can't get my hands on any. The IMF only issues them to member countries, and they're traded among the members through a secret trading desk inside the IMF. If I want to buy gold, I use dollars. In China, they can buy gold with yuan. The idea of buying gold with SDRs may be off in the future, but there's no active gold market priced in SDRs today. Or is there? DHB took a look. What he found was shocking. It's summarized in this chart. Source, D.H. Bauer. The timeline along the horizontal x-axis runs from December 31, 2014 to March 31, 2018. The price line along the vertical y-axis is measured in units of dollars or SDRs depending on the data series. The units run from 701,400. The red line is the dollar price per gold ounce, USD/GLD. The dark blue line is the USD/GLD trend. The green line is the price per ounce of gold in SDRs, SDR/GLD. The purple line is the SDR/GLD trend. The black vertical line indicates the date, October 1, 2016, that the IMF allowed the Chinese yuan to join the basket used to determine the value of an SDR. The rest of the basket consists of dollars, pounds sterling, euros, and Japanese yen. Here's what DHB discovered. Before China joined the SDR, both the dollar price of gold and the SDR price of gold were volatile. After China joined the SDR, the dollar price of gold continued to be volatile, but the SDR price of gold exhibited much less volatility, especially after the first few months. Most importantly, the trend line of SDR/GLD is a near-perfect horizontal line. In short, world money has now been pegged to gold at a rate of SDR 900 equals 1 ounce of gold. It's a new gold standard using the IMF's world money. There's the GMR right in front of your eyes. It takes a while to sink in. Why did SDR/GLD go from normal volatility to no volatility overnight? The straight line behavior of SDR/GLD after the Chinese yuan joined the SDR is impossible without some kind of intervention or manipulation. The odds of this happening randomly are infinitesimal. The SDR/GLD horizontal trend line after October 1, 2016, is an example of what statisticians call autoregression. This only appears if there's a recursive function, a feedback loop, or manipulation, or if it's presented as a fraud. This is how Harry Marco Polo spotted the Bernie Madoff fraud. Madoff's returns were too steady and consistent to be real given the volatile nature of capital markets. In the case of SDR/GLD, we can rule out a recursive function because gold trades in a relatively free market determined by supply and demand. We can rule out randomness, statistically impossible, and fraud. The data come from public sources, no one is making them up. That leaves manipulation as the only possible explanation. How would you conduct such a manipulation, and who's behind it? To peg a cross rate, in this case SDR/GLD, you need a large floating supply of both components or a printing press to make as much as you need. Basically, you conduct open market operations. If the SDR price of gold rises above SDR 900, you sell gold and buy SDRs, or the currency basket. If the SDR price of gold sinks below SDR 900, you buy gold and sell SDRs, or the currency basket. By monitoring markets and intervening continually with open market operations in gold and currencies, you can maintain the peg. There are only 4 parties in the world who could conduct such a manipulation: the U.S. Treasury, the ECB, the Chinese State Administration of Foreign Exchange, SAFE, and the IMF itself. These are the only entities with enough gold and SDRs to be able to conduct the open market operations needed to peg the price. We can eliminate the U.S. Treasury and ECB as suspects. That's because they are relatively transparent about their total gold holdings, foreign exchange reserves, and the SDR component of their reserves. For the ECB, we look at the large members such as Germany and France for the data. If either one were conducting open market operations, there would be fluctuations in holdings of gold and SDR component currencies that would appear in official reports. No such fluctuations appear, so they're off the list. That leaves SAFE and the IMF. Both are non-transparent. China has about 2,000 tons of gold, probably much more, but they don't disclose the excess, and has been acquiring SDRs in secondary market trading in addition to official allocations to IMF members. The IMF has about 1,000 tons of gold and can print all the SDRs it wants with its SDR printing press. The IMF also makes loans and receives principal and interest in SDRs. The SDRs can be traded through the IMF's secret trading desk. Even now, the IMF is preparing to bail out Argentina. When that happens, the IMF loans will be in SDRs. Argentina needs dollars to defend its currency, so they'll have to swap their new SDRs for dollars. China will be a willing swap counterparty through the IMF's secret trading desk. That's how China acquires more SDRs than its IMF allocation permits. Those extra SDRs are crucial to China's ability to conduct open market operations in gold and SDRs. The gold can be traded secretly through the Bank for International Settlements, BIS, which traded Nazi gold in the Second World War. The BIS is super secret and is controlled by the same people who control the IMF. China can also conduct gold purchases and sales for yuan or dollars on the open market in Shanghai and London, and separately buy or sell SDRs for dollars or yuan. China can also buy or sell the SDR basket currencies separately as a synthetic SDR to manipulate the price of the actual SDR. This kind of intervention by China to maintain the SDR/GLD peg might also explain the mysterious gold slams we see in COMEX gold futures trading with regularity. Analysts have speculated for years that China was acquiring gold in anticipation of a new gold-backed yuan. I always disputed that idea because China does not have a good rule of law. The yuan lacks the kind of deep liquid bond markets, primary dealers, repo facilities, futures contracts, and other legal infrastructure needed to be a major reserve currency with or without gold backing. The yuan is a decade or more from becoming a major reserve currency, but the SDR is an ideal vehicle for a gold-backed currency because it has the support of every major economic power on earth through the IMF. The bottom line is that China has now pegged the SDR to gold. This is highly ironic, because when the SDR was created in 1969 it was originally pegged to gold and defined as a weight in gold, SDR1 equals 0.88867 grams of gold. That peg was abandoned soon after, even as the dollar peg, $1 equals 1/35 ounce of gold, was also abandoned. Since this SDR peg to gold is informal, it can be abandoned at any time. It probably will be abandoned because the Chinese sponsors of the peg have ignored the lessons of 1925 when the UK returned sterling to the gold standard at the wrong price. The result was catastrophic deflation that presaged the Great Depression. The Chinese peg of SDR 900 is far too cheap to be sustainable given the scarce supply of gold and the growing supply of SDRs. More to the point, the IMF will print trillions of SDRs in the next global financial crisis, which will prove highly inflationary. Still, this is a historic development, and we'll be watching it closely in Rickard's Gold Speculator. Even if the peg is unsustainable in the long run, it's a clear short-run signal that China is betting on the SDR and gold, not the yuan or the dollar. My advice under these circumstances is simple. Dump dollars, yuan, and SDRs, if you have any, and get gold. That's where the whole world is heading. All the best. Will China start a currency war against the dollar? Will China start a currency war against the dollar? The action would be in retaliation against Trump trade tariffs, with a weaker yuan better for Chinese exporters. The problem is that the yuan's weakness has about as much to do with Fed tightening and reducing its balance sheet as it does the People's Bank of China moving the needle on its managed free-float trading band. Some global investors think the yuan is going to 7.25, especially if the dollar continues to strengthen. If the dollar keeps strengthening and gold goes below $1,200 an ounce, you should not be surprised to see the yuan go to 7+. The correlation between them is that strong, says Vladimir Signorelli, a macro investment analyst at Bretton Woods Research in New Jersey. China's yuan trades within a band of 4% in either direction. If the currency moves higher on that band, the central bank will take the high point and make it the start of a new 4% price range. The currency is down 8% since April and 4% year to date. We see a moderate depreciation in the yuan in the near term, says Richard Turnell, chief investment strategist at BlackRock in New York. Chinese authorities are managing competing policy goals in a challenging environment, he says. The Fed is tightening and shrinking its balance sheet, which is reducing the number of dollars out there. That's a positive for dollar bulls, but it is also making U.S. exports more expensive. For China, seen as a competitor for U.S. businesses in Asia and elsewhere, the yuan's weakening to 6.80 on Monday morning is a combination of dollar strength and a slower Chinese economy. The yuan has been at this level before. It tested 6.90 at the start of the year. The Chinese currency has been weakening since the election of Donald Trump. China is in semi-panic mode. They're cutting taxes, cutting interest rates and initiating fiscal policy changes to stimulate the economy, all in anticipation of tariffs. Turnell said he does not see China resorting to a 2015-style devaluation to cushion the blow from trade tariffs. Though his calculation at this time is based on the $50 billion in tariffs enacted this month. Trump is threatening over $200 billion more in tariffs, which would absolutely bring the trade war to DEFCON 4. In 2015, a lack of market confidence in China's currency policy contributed to capital flight, spooking global markets. China later said that it was changing its trading band for the yuan in anticipation of joining the International Monetary Fund's currency basket, the special drawing rights. China has stricter capital controls in place to avoid panic selling of the yuan and improved coordination between policymakers. For Turnell, this should give the government the confidence to allow the yuan to gradually slide lower. A sharp yuan depreciation would undermine Beijing's deleveraging effort, by driving capital flight and further tightening domestic financial conditions, Turnell says. It could also fuel inflation and dampen foreign investors' growing interest in China's domestic stock and bond markets. The A-shares of mainland China companies are down over 20% from their highs reached on January 26. The X-Trackers Harvest CSI 300 China A-shares, ASHR, exchange-traded fund is down a tad on Monday and off 17.5% year-to-date. The U.S. Treasury does not consider China to be a currency manipulator. Therefore, any weakness in the yuan is more likely a market move than the handiwork of Beijing central bankers. President Trump said last week the Fed's hawkishness is making the dollar uncompetitive. Unsurprisingly, Fed officials are pushing back against any interference in their independence and said monetary policy is not a mystery. The Fed meets again next week and markets expect another 25 basis points rate hike, the third this year. That will likely push emerging market currencies lower, including China's. The market expects one more rate hike this year, 3 more next year and 1 more in 2020. At that, Trump noted that the Chinese currency has dropped like a rock, implying that China is manipulating the currency. Treasury Secretary Steve Mnuchin says the U.S. will investigate whether the recent yuan depreciation is the result of manipulation and the findings will be presented in the usual semi-annual Treasury report in October. Meanwhile, Trump is threatening to impose tariffs on all Chinese imports, making the yuan even more bearish than the Fed's monetary policy. The trade war continues to escalate, says Neil McKinnon, an economist at VTB Capital. Right alongside what looks like an outright currency war, he says.